Good evening and welcome to the Tri-Council Development Fund's Town Hall on the Illinois Fair Tax Constitutional Amendment. I'm Zach Lowe, Director of Planning and Programming for the Tri-Council Development Fund. Thank you all for joining us this evening for what I know is going to be a very engaging and informative program. But before we get started, I'd just like to take a quick moment to share some information about the Tri-Council Development Fund. TCDF is a collaboration of Illinois finishing trades organizations, which include Painters District Councils 14, 30, and 58, and their allied contractors association, the Finishing Contractors Association of Chicago, Finishing Contractors Association of Illinois, and the Associated General Contractors of Illinois. The TCDF utilizes the collective leadership, advocacy, training, and other resources of these organizations to protect workers, support contractors, and strengthen Illinois communities. As a community-focused initiative, the TCDF partners with municipal governments, with community-based organizations and other stakeholders on projects that promote high road construction practices, advance economic justice, and catalyze inclusive growth. You can learn more about our website, find out more about our upcoming programs as they evolve, and find more about our programming in general at our website, which is tcdfillinois.org. And with that, I'd like to introduce this evening's moderator, Todd Dotson, who is the Executive Director of the Tri-Council Development Fund. Todd is an accomplished labor leader with over 27 years in the finishing trade industry, much of it with PDC 30. Throughout his career, Todd has served the union in a variety of leadership capacities. Todd currently serves as a trustee on the PDC 30 Health and Welfare and Pension Fund boards, and is a past chair of PDC 30's Labor Management Industry Development Fund. Todd is a registered lobbyist for the Tri-Council Development Fund and regularly advocates for pro-labor management public policy initiatives in Springfield. With that, I will turn it over to Todd. The floor is yours.
Thank you, Zach. Before I introduce tonight's panelists, I'd like to take a moment to explain to our viewers and phone participants the framework for tonight's program. We have received dozens of questions and have incorporated your questions into tonight's discussion. Tonight's program will break down the Fair Tax Amendment into 4 separate issue groups. The first issue group will be an overview of the current tax law and a detailed explanation of the Fair Tax Amendment proposal. The second issue group will address the question of retirement income. The third issue group will discuss how the fair tax impacts small business. And the final group will be a series of questions that fall outside the previous categories. We expect some of our answers may be repetitive, and that is okay, as our goal is to ensure that all of your questions are answered by our expert panelists. With that, I am very pleased to be able to introduce Mr. Cameron Mock as tonight's presenter on the Illinois Fair Tax Constitutional Amendment. Cameron Mock has spent nearly a decade working for state and local governments on tax and economic policy and public finance issues. He currently serves in the Governor's Office of Management and Budget as Chief of Staff and Senior Fiscal Advisor to Deputy Governor Hines, where he focuses on a number of issues including income taxes, property taxes, and public pensions. He has played an integral role in some of Governor Pritzker's key policy priorities, including creating a fair income tax structure in Illinois and consolidating local pension systems to provide greater investment scale and reduce the burden on local property taxes. With the current pandemic, he is currently overseeing the state's modeling of the epidemiological curve to advise on the state's economic recovery plan and managing the state's effort to stand up drive-through testing statewide. So with that, and I want to say thank you to Mr. Mock for sharing some time with us this evening to educate us all on the Illinois fair tax. And with that, I'd like to jump right into tonight's discussion. Let me begin with a broad question. How did we get here? Why does Illinois have a flat tax? And why are lawmakers proposing that be changed now?
I believe, Todd, that Cameron had a little bit of a technical issue. He's connecting to audio now, so we should hear him any moment.
Okay, terrific.
Hi, can you hear me?
Yes, sir.
All right. Apologize for the technical difficulties.
Sure. Would you like me to repeat the first question?
Oh, yes, that would be great.
Okay, terrific. So I want to begin with a broad question so we can really expand our conversation tonight. But ultimately, when we talk about the fair tax, how did we get here? Why does Illinois have a flat tax? And why are lawmakers proposing that be changed now?
Sure. Well, the flat tax was originally created or authorized in the state constitution beginning and enacted in 1971. At the time, you can imagine that the tax picture, the financial picture, looked a lot different then than it does now. Income inequality in particular wasn't nearly what it is today. The certain stressors that we have from issues specifically around the underfunding and poor investment of certain pension funds through the early 2000s wasn't there. A lot of different things were in place then than there are now. And as you could imagine, especially at the federal level in the U.S. Constitution, as societies evolve and as things change, the bodies of laws that govern the people of the state, or in this case, the country, change and adapt in accordance. Now, the constitutional provision has a higher threshold for getting over it, but the reason why now we're looking for a fair tax is what we've seen over many years, decades even, is the income inequality in the country and in the state has grown substantially, such that the wealthiest folks in the state and in the country, primarily because they're utilizing capital gains for their income is growing far substantially more than wage earners, folks who are earning an honest living, through wage income. And so over time, what's happened is the income gap has grown substantially. You have a tax system under the flat tax that doesn't generate the growth and revenue that's required to meet the expenditure growth. And as such, right now, we're looking to join nearly most other states who have an income tax and the federal government in making the system varied by rates by income, so that if you're lower income, you actually pay less than you would today, even if you're middle income or even middle high, and only the highest 3% of earners would pay more. So, today we're looking for a change to the tax code that reflects the modern challenges we have today and what we've seen over the last several decades in income inequality. And some folks may point to, why not just cut your way out of this problem? We're facing pre-COVID, we're facing about a $3 billion deficit. And why not just cut your way out of this? And, the governor has been very firm on looking for efficiencies in state government. He is a businessman, and so he wants to see those operating efficiencies. But what's really important to keep in mind is if you look at the U.S. Census Bureau, the state of Illinois actually has the second leanest state government in the entire United States. That is the second fewest number of state employees per capita in the entire country. So for decades, for years, the state of Illinois government has been hollowed out. We're now running extremely lean. There are still areas for efficiencies, but it's not to the tune of $3 billion. So what we're really looking for is a pragmatic approach to generating those additional revenues by not hurting lower and middle income working class families, and in a way that'll address this structural issue going forward.
So just to get the conceptually, how we get here. So I think it was a great explanation, but so moving forward, how does an amendment to the Constitution happen, and why is this question on the ballot?
Sure. So generally speaking, just from the process standpoint, an amendment to the Constitution generally requires the General Assembly, both chambers of the General Assembly, to pass a bill with a 3/5 majority that puts a question before the voters on whether or not they want to adopt a certain change to the Constitution. In this case, that happened with the fair tax last spring. And included with that also, while the rates aren't stipulated in the Constitution, the statute does stipulate the rates. So the General Assembly already also passed the rates. And so what's important about that is when voters go to vote on constitutional amendment, they'll be able to see the corresponding rates they're in effect voting on. And we felt that was important to get done for full transparency in front of the voters, so that it wasn't just some ambiguous or nebulous set of rates, while we still asked for the voters to modernize the tax system. So once it goes to the voters, you either need 50% of those voting on the question, or a 3/5 majority, a 3/5 majority of those voting on the question, or a simple majority of those casting ballots in the election. And that's the decision that's going to be made by the electorate on November 3rd. And again, the reason why we need this constitutional change is because the Constitution currently, again, it's over 40 years old now, this provision, but stipulated you can only levy one tax rate on all income levels, regardless of ability to pay.
Okay. Well, let's stay broader for just a little longer. Help our members and contractors understand the problem the governor and the legislature are trying to solve with the progressive income tax.
Sure. So as I alluded to before, right now we are facing about a $3 billion deficit. We have pre-COVID. We're hoping when the Fed step in and extend us and every other state a lifeline, really, because this is not relegated to Illinois, that we'll be back in that position that we need to close about a $3 billion gap. And that $3 billion gap looks at things like funding $350 million additional into education funding, K-12 education, funding critical human services. A lot of our vendors who support elderly and disabled individuals have been delayed, especially in the past administration as the bill backlog grew. The comptroller would hold up payments because he didn't have the cash to pay it. And so what we're talking about is funding critical services, fully hitting the $350 million additional a year for education. A crucial one is, the governor has been firm about this, is public pensions is a promise that's been promised to the workers in the state, and that he is not going to seek, as some would hope, to try and renege or reduce those benefits. That it's clear as the obligation is to pay it. The question is, how do we pay it? And in order to continue down the path towards structural balance, to continue fund these critical services, and one of the most critical things, get the pension funds fully funded, we need this additional revenue. What's important too is we're on this ramp towards pension funding, and that grows every year. What's important about the fair tax is, because it creates higher rate for higher income individuals and a lower rate for lower income individuals, the fact that income inequality grows quickly means that the wealthiest individuals accumulate wealth faster than the lowest income individuals. And so what that means is, by going to a graduated tax structure, not only are you creating equity today, but over time you actually generate additional revenue as the wealthiest folks get wealthier. You can look at the top income tax brackets in the state. You can see their wealth is growing by in excess of 3.5%, 4% a year, while the ones at the middle and lower income levels have been fairly stagnant over the last decade. And so that's important, not only from an equity perspective, but that substantial additional growth in revenue will assure us that we can continue to fulfill those obligations to make the full pension payments that we're required to under statute, and fund all of these other critical investments.
Can you briefly explain what the new tax rates are? I understand you indicated that the legislature has already passed what the tax rates are, but just for our viewers and listeners tonight, can you review what those are for us?
Absolutely. So obviously, currently we have a flat tax rate of 4.95% on all individuals, regardless of income. The bill that was passed before the General Assembly, and was largely intact what the governor had proposed when he initially rolled this thing out, was a lowest rate starting at 4.75%. So that's a reduction of 20 basis points in taxes for the lowest income bracket, which is up to those with $10,000 in income. And those rates grow from 4.75 to 4.9%, up to $100,000, and they keep growing until you get to, for instance, married filers. Once you hit over $1 million, your tax rate goes to 7.99%. Now, the important thing to keep in mind is there's a lot of misinformation or misunderstanding about what a marginal tax structure does. What people like to point to is, look at, let's say I make $100,000, $150,000, and I fall at the 4.95% rate. That doesn't mean I pay 4.95 on my entire amount of income. That's only on the income that's above the $100,000 threshold. So even if I make $150,000 a year, which isn't uncommon to have, say, a firefighter and a teacher married, to make that level of income, they're actually going to see a tax reduction because the lower income levels are actually taxed at a lesser rate, such that by the only time you exceed the rate you pay today is once you exceed the $250,000 threshold, which is about only 3% of our filers in the state exceed that threshold. Then you're actually going to pay a higher rate. But you have to smooth out these rates, and you come to what's known as an effective rate, what you actually effectively pay in taxes. And in the case of the fair income tax, that would be a lesser rate for 97% of filers.
Terrific, thanks. I'm sorry.
Oh, I'm sorry. I will also add in too, there's a couple of things besides the rates that were passed too that's helpful. One is a new child tax credit that would provide $100 per child for folks. Almost everybody, if you're married, the tax credits phase out around $500,000 a year. And then also the governor had proposed, and it was implemented in the bill, increasing the property tax credit. So right now in Illinois, when you pay income taxes, you indicate on your income taxes how much you pay annually in property taxes, and the state actually gives you a credit to offset some of those. The governor's actually proposed increasing that, and it's part of law now, increasing that, assuming the fair tax goes into effect, by 20%. And so that's immediate property tax relief just with that credit.
Terrific. I think it's great information for our viewers and listeners to get and truly understand. So thank you for that. Back on September 24th, it was reported that Lieutenant Governor Juliana Stratton said if the graduated income tax fails to pass, lawmakers, quote, will be forced to consider raising income taxes on all Illinois residents by at least 20%, regardless of their level income, end quote. If that were to happen, it would push the current tax rate to around 6% and would only require a simple majority vote in the legislature. Is this indeed a likely outcome if the fair tax amendment fails on November 3rd? And if so, can you elaborate on why this may happen?
Sure. So, it's tough to say whether it's likely or not because it requires the General Assembly, and I do try to keep my pulse on them, but it's all dependent on what they're hearing from their constituents. But what I can say is that we need more revenue, plain and simple. I indicated before we're one of the leanest state governments in the country. I came from Chicago Public Schools where I was advising on finances there, and what we saw there is from 2009 all the way until 2016, not only not in terms of inflation adjusted dollars, but actual dollars going to public schools decreased every single year. It caused a great budget crunch for many of these schools and resulted in 2/3 of the school districts in the state having a deficit spend to make up what basically the state was failing to make up. So the point being now, we're at a crossroads where we cannot cut our way out of this. The governor's going to keep pushing those operating efficiencies. He's going to keep pushing. He keeps giving directives to his cabinet that they need to cut and find efficiencies, and he's done yeoman's job at that. But with that said, we need revenue. And so I can't see any other way you get to that revenue if the fair tax passes without a flat income tax increase. And this is really important to keep in mind because what's interesting is you've seen business groups and wealthy individuals come out actually with proposals to both tax retirement income and to increase the flat tax. And one would say, why would they ever propose that? And the answer is because they're going to pay less under an increased flat tax than they are under a fair tax. For instance, if the flat tax were increased to nearly 6%, the tax break is no longer at those making $250,000 a year. You'd actually could make upwards of $400,000 a year and still get a tax break under the fair tax. They know that it's better for them to pay 6% in a flat tax and push that burden on the middle and low income families because they get to save that money as opposed to paying the 7% the wealthiest individuals pay under a fair tax. And so that's why they're really pushing for no fair tax, and they've generally accepted a flat income tax increase. So I think it's funny, it's made some news lately. The governor, they say he's threatening this fair income tax. There's no threat. When we rolled this out in his budget address, he said there's three options: cut operating budget by 15% across the board, fair tax or raise the flat tax. And unless the people opposed to the fair tax come forth with $3 billion in programmatic cuts that are doable, there's just no other way around it.
Yeah. Okay, thank you. So we talked about this a little bit earlier, but I'm aware that the federal government utilizes a graduated tax structure. How many states are currently utilizing a graduated tax structure? And what has Illinois learned from other states who utilize this type of tax system?
Sure. So I'll actually flip it and I'll say the number of states who don't, because it's such a substantial proportion of states that do. Illinois is one of only 9 states that have an income tax that don't do it on a graduated level. And so we're anomalous in that respect. What we've learned from other states, and the reason why I just did a podcast with a publication called The Bond Buyer, and it's about people selling and buying municipal debt, and everybody's wondering, what is Illinois going to do about its really low credit rating? And we're the worst in the nation, honestly, in terms of credit rating. And that's in large part because of the antiquated tax system. So what we see in states that have a graduated tax structure, their revenues grow at a much greater rate sufficient to meet demand, and they don't have the same level of income inequality that we have. And income inequality is important from an economic standpoint too, because as you know, small businesses and working class families are the backbone and structure behind the economy. Without those individuals, you don't have spending that results in major corporate profits or anything like that helps the wealthiest individuals. And so you need a strong economic base, and you can't get there if you're taxing your lowest income individuals at twice the rate you're taxing your highest income individuals, which is the case in Illinois. So we have the most regressive system in the state. And so switching to a fair tax would be a way that we could better help us create a stronger economic base with those middle working class families. And what we have noticed, and I can touch on this later because I'm sure it's of interest, but the body of economic research not only shows that it makes the tax system fairer, it creates structural balance in these states' budgets, but it doesn't lead to an exodus of wealthy individuals. The burden of moving from where folks have their social circles, their kids go to school, where their businesses are, et cetera, is the value of those things are far greater than the nominal increase that they're going to pay in taxes. And I'm an economist, and so the body of economic research shows that wealthy individuals do not respond very strongly to changes in state income taxes, largely because we're not talking about the federal rates that are 30+%. We're talking about the
I think Cameron, I think you froze up on us. Give it just a second here.
Yeah, Todd, I think we need to give him just a second. He looks like he's trying to get back on.
Yeah.
Apologize for that. There he comes.
There he is.
Hey, so like I said, the reason really is that state taxation is nowhere near the size of the federal government's taxation. So when the federal government, the highest rate is in excess of 30%. In the state, we're talking about millionaires and billionaires here, going from 5% paid in state taxes to just under 8%, basically just under 5 and just under 8. That 3 percentage point difference is not enough from the economic research, not enough to force some mass exodus out of Illinois.
Yeah, well, that is a topic that we'll cover a little bit more in greater detail a little bit later tonight. But I'd like to now pivot to our second issue group, which is a really hot button topic that deals specifically with the retirement income. Recently, there's been a lot of discussion surrounding the potential taxation of retirement income if the fair tax passes. I'd like to spend a couple of minutes unpacking this issue. First, can you explain how retirement income is currently taxed in Illinois? And does the fair tax change how retirement income will be taxed?
Yeah, so Illinois currently is only one of 3 states that does not tax 401k, IRA, retirement dividends on their residents. So we're one of only 3 states, and that that requirement is stipulated in statute. It's got nothing to do with the Constitution. So why it's important is because this is a proposed amendment to the rate change to being able to levy graduated rates based on income level, and has nothing to do with the constitutional provision around taxing retirement income. So in summary, the fair tax does nothing to change the authority of the General Assembly to tax or not tax retirement income. And what I'll say is retirees, AARP, are the strongest, most consistent voting bloc in the state of Illinois. And the General Assembly, either under a flat or a fair tax, if they wanted to change the law so that we're not one of the 3 states that doesn't tax retirement income and wanted to tax it, a lot of them are going to be voted out of office. I'm guessing retirees are going to have something to say about it. Now, the current governor, Governor Pritzker, is not in there forever, of course, but what he has said also is that as long as he is governor, he is not going to pursue the taxation of retirement income. So not only do you have no change to the legal authority of the state to tax or not tax retirement income, but you have a governor who said he's not in favor of it, and requires his signature on that bill. Whether we have a flat or fair tax, the requirement is exactly the same. Nothing changes. It is a misnomer. It is misinformation meant honestly to scare people into voting out of a fair tax system.
That's great, and we received a lot of questions around this issue. Obviously, it's out in the political universe. Proponents are saying one thing, and the opponents are certainly coming out saying that it's going to make it easier to tax retirement income. But just to be clear, because it's such an important issue for our viewers tonight, what I'm hearing you say is that retirement income will not be taxed under the Fair Tax Amendment, and that in order to tax retirement income, a law would have to be introduced and passed by the General Assembly and signed by the governor. And we know now just recently that Governor Pritzker has come out and formally said that he is adamantly opposed to it. So am I stating that correctly, that there will be absolutely no change to retiree income?
That is correct.
Yeah, that's a big issue. I really am glad that we were able to flush that out, because it was an important issue for the folks that have taken the time to join us tonight. I'd like to now pivot to our third issue group, which deals specifically with the impact the Fair Tax Amendment could have on Illinois small business. Due to the COVID-19 pandemic and the resulting stay-at-home executive orders, many of Illinois' small businesses are struggling with reduced business activity. Small businesses create about 2/3 of net new jobs in the country and account for 44% of U.S. economic activity. I'm sure you agree that small businesses should be included in the conversation regarding how the economy will recover from the COVID-19 pandemic. So in recent weeks, I've heard opponents of the fair tax argue that it will cause a mass exodus or failure of many Illinois small businesses. Can you speak to what other states have experienced after they adopted a graduated income tax structure with respect to businesses leaving their state based on tax policy?
Sure. So first I'll address this idea that businesses specifically would leave in response to the fair tax. Small businesses in Illinois actually don't file income taxes. Their shareholders, their partners file it with their individual income. So if they have a partnership in a business and they also have some wage income on the side, they combine the two and they file their taxes as individuals on behalf of the business. Now, so why that's important is that when you look at, when we talk about this 97% of filers will pay the same or less, that includes every single small business owner in the state. And when we look at just small businesses alone, what we can do is, even though the individuals file those, so it's a little bit difficult to know, because the idea of a small business filing income taxes is a bit of a misnomer, because the individuals who actually own the business file it. But what we do know is these small businesses file income tax statements every year with the Department of Revenue. And what we've looked at, we've done a tax impact analysis on these small businesses and determined that at the very least, and I did this as conservatively as possible, at the very least, 95% of small businesses will actually see a tax cut under the fair tax plan. So that is what's really interesting, is the opponents want to claim that businesses leave in droves in response to taxation. But when I point to them that 95% of businesses will receive a tax cut, they immediately abandon that and say they will still leave for one reason or another. So I believe, if you want to believe that businesses vote in response to taxation, well, 95% of small businesses are going to get a tax cut. But what the economic research shows, again, is that they're not strongly responsive to small changes in tax policy at the state level. And so even for those 5% of small businesses who will pay nominally more, and I say nominally more because if you're a big business, you're likely a C corporation, and you pay the corporate income tax. You don't pay the individual income tax. And what's important about the corporate income tax, I won't go too much into it because we're really talking about small businesses, but even the corporate income tax, under that, the state uses what's called the single sales apportionment factor. And that is, the state only taxes corporations based on the business done in Illinois. And it's completely irrespective of where your business is located. So if you're a corporation and you do business in Illinois, whether you're located here or not, you pay the corporate income tax rate on the business done in Illinois. And so what that means is changes to the corporate income tax really have no change, no influence on a decision of a corporation to locate or not locate in the state, because they still pay that tax whether they are located here or not. So there's going to be no change in corporations and where they locate. So the big employers, but the smaller employers, which actually aggregate to the largest employers, the vast majority will actually see a tax cut. So we feel it is in addition to giving small businesses a tax break, but giving their workers a tax break. We feel it is an extraordinary step that would help retain and attract new businesses.
I think that's really a great point to bring up. I personally was unaware that 95% of Illinois small businesses would receive a tax cut under the proposed fair tax amendment. That's something I've not heard yet. So I think it's really important information, especially for our contractors, many of which are small business, and it's a critical issue for them as well. So to build off of this questioning, proponents of the fair tax argue that the real way to attract and retain small businesses in Illinois is for Illinois to shore up its fiscal house by balancing the budget and finding a solution to the Illinois pension crisis. As a budget and policy expert, can you explain the theory behind this position and why the budget may play a greater role in keeping and attracting small business more so than the income tax structure?
Yeah, that's a great great subject. So one of the things, and I get on the field quite a bit, and we constantly poll Illinoisans and small business owners. And one thing I hear overwhelmingly so is, A, I'm sick of the uncertainty that's surrounding Illinois' finances. And B, I've even spoken to my wealthier friends who have indicated that they would actually be willing to pay a slightly higher rate if they just stop hearing all of the uncertainty and negativity around Illinois state finances. So the idea that you have a strong structure for businesses. So one of the things that's most important is a lot of the workers at these businesses obviously enroll their kids in public schools. So if you have a state who is cutting education spending, who at some time in the prior administration, we had twice where it was uncertain whether schools were actually going to get their state aid in time. And you're talking about risking closing schools, delaying school programming, et cetera. That is vitally important for the workforce of these businesses. So when you have a sustainable and calm sense of funding structure for your education, for your critical services, you create a sense of stability for the workers that are employed by these businesses, and therefore you improve morale and productivity. And so we feel it is vitally important that if we can get the fiscal house in order vis-a-vis the fair tax, that the strength of the Illinois economy will become even stronger, and that small businesses will be able small business owners will be able to go to bed knowing that they're not risking, say, not getting paid by the state, or if the state doesn't pay its workers, it doesn't pay its public pensions, workers don't have that money to spend in the economy. Or, in the case of pensions, you have all these people who have basically put their entire lives in retirement on the line for a public pension. And without this revenue, folks start to talk about, what do we have to do with pensions to reduce the benefits or change the structure? And it creates a great deal of uncertainty for the public sector workers. And so as the underpinning of the economy, these working class families, by shoring up the budget, will have a much stronger sense of certainty. They know their kids' schools will be better funded, and there won't be risk of, say, closing programs or delaying school as a result. And so it's vitally important for the state's economy that we produce that additional revenue in an equitable manner.
I'm really pleased that you brought up the school issue, because we've visited with several superintendents over the years. And actually, I believe we have a couple of school superintendents on our program, or with our program tonight. So I appreciate the fact that you brought up the heartburn that the previous administration caused with respect to schools, and it makes sense, your explanation with respect to how all of that unfolds moving forward. But speaking of outmigration, recently the Center for Tax and Budget Accountability released a study that debunks the myth that tax policy is correlated with outmigration of certain individuals with higher income levels. Is there any concern, and I think we just alluded to this, and this is why when we opened up, we said we might have some repetitive answers, but maybe it gives you an opportunity to expand on it a little bit more. But is there any concern that a graduated income tax system will force higher income individuals to flee the state and then arguably take their income with them, particularly now that we are many people are working remotely? Where can their home base be established, et cetera? This is, the new business model in the light of COVID. But could you elaborate on that for us?
Sure. In short, there is very little concern around that, and I'll tell you why. So there are a series of, and these are peer-reviewed academic researchers from Stanford, Princeton, et cetera. You have a number of studies, and this is one from Varner, and I forget his co-author's name. New Jersey had an interesting study, which actually grad school policy and public finance schools tend to teach, and this is a really important lesson. New Jersey was a really important case study. They went from a flat income tax to a graduated income tax. And the researchers wanted to look at, they had a case study now, they had a control for what it was like under the flat tax, and they wanted to look at what millionaires would do when their income taxes were increased in New Jersey. And New Jersey is in particular important because of its relative proximity to other major metropolitan areas in other states, New York, Pennsylvania, et cetera. And so the thought was, if anywhere in the country folks were to flee in response to changes in state income taxes, it would be New Jersey, because they can easily move to other surrounding states and still maintain those same things I said before. Their social circles where their businesses are, they could still commute in an area of virtual work too, would be easy to relocate. What they found in that study is, and I'll get a little wonky here, but in effect, what the economists call it is it's on the margins of socioeconomic semi-elasticity, which in layman's terms means that folks at higher income levels did not respond by moving in response to the state changing to a graduated income tax. Now, there was a 0.2 semi-elasticity, which meant a couple hundred, I believe, millionaires and billionaires left. So what we did in our revenue estimates as well is we assumed some reasonable margin would leave, but that is, I think I just saw an article where a research institution computed what that would mean in Illinois, and that would be approximately $40 million loss on 3.6 billion. From the fair tax. So I'm not here to say that not a single individual will leave the state, but what I can say with near certainty is that based on the economic research, that high income earners do not respond by moving in response to changes in state income taxes. Now, you'll probably get an article or two on conservative media outlets that will be somebody leaving the state, and I fully expect the first millionaire or billionaire that leaves the state is going to write into a local article and say, gee, thanks, fair tax. But my assertion is that they were leaving regardless of fair tax, because the burden of moving is far greater than the additional marginal increase in state income taxes. And to your point about businesses, the fact that it creates underpinning of economic stability means that you're talking about possibly wealthy individuals paying a small increase in their state income taxes, but have a much stronger and predictable workforce that will produce productivity that will likely offset any changes in their actual individual tax liability.
That's terrific. And actually, in preparation for tonight's discussion, we did some research on the New Jersey experience. And just so for our viewers and listeners, we'll get that migration study posted on the tcdfillinois.org website for anybody that would like to go out and learn a little bit more about that study. It was actually quite fascinating to learn exactly the outcome that New Jersey experienced as a result of moving to a graduated tax away from a level tax. So moving on, it's also been argued that the proposed fair tax is the only way to help the middle class and working poor pay less in taxes. Specifically, the Institute on Taxation and Economic Policy recently reported that the bottom 20% of Illinois earners pay 14.4% of their total income to state and local taxes, while the top 1% of earners pay 7.4% of their income in taxes. How does the Fair Tax Amendment potentially change these numbers?
Yeah, it's a very good question. And first I want to lay out, it may be, and when you first hear it, you kind of think, well, how in the world is that possible? Because you think, well, everybody pays the same income tax rate. Everybody pays the same sales tax rate. Everybody pays generally the same rate on their property value in property taxes, et cetera, et cetera. And so you look at the body of these local and state taxes, and one would expect it to be fairly even across the board. What's happening is most of the taxes that we have out there are actually regressive. So sales tax, for instance, folks at the higher income levels do not pay the same proportion of their income in sales tax as lower individuals, because wealthier individuals have a lot higher in savings. They have a lot higher in retirement income. These are things that are not, not being spent on everyday items that would otherwise be taxed in sales. You have those at the lowest end who are paycheck to paycheck, by definition, are spending almost all of their money on critical items for them and their family. And so what happens is as a proportion of income, even though the tax rate is the same, they actually pay substantially less as a proportion of income than the lowest income individuals. And housing is a good example too. So property taxes, well, still tend to be regressive, primarily because a millionaire or billionaire is not going to have a house at scale, the amount of house greater than those lower individuals, so that they may have $1 million, multi-million-dollar home, but a lower middle income family that has a $200,000 home is paying way more in property taxes as a proportion of their income than a wealthy individual. So all of those things add up, and then you come to the flat tax, which doesn't do anything to address it. You can't really address it in sales tax, because what are you going to do? Income test people at the register? It's very difficult to address the regressive nature of sales tax. But what you can do is look at the largest source of income for the state of Illinois, which is the income tax, and you can address these inequities by changing that structure. And so to your point, what they found was that the lowest income, the lowest 20% of earners paid roughly 2 times as much as a proportion of their income as the highest income earners do in state and local taxes. So that makes us the 8th most regressive system of taxation in the country. What the fair tax would do, and the New York Times ran a report showing what this would do, is under the fair tax, that would make the tax structure, I computed 63% more equitable. That would be, instead of paying, like you said, the lowest 20% pays 14.4, the highest 1% pays 7.4%. And that would change the equation, where the bottom, again, it's a modest tax reduction, but the bottom would go from 14.4% to 14.1%. But where you really make up some of the gap in the income inequality is the highest 1% of individuals will go to only paying 7.4% of their income to 9.8% under the fair tax. And so that's what equates to, it roughly makes the system 63% more progressive. And furthermore, not only just with the adjustment of tax rates, but what we're really talking about is funding critical public services with the enactment of the fair tax. And what that does is disproportionately help low and middle income class families and reduces the burden on property taxes because it's going to be used to help fund primarily education, which is the vast majority of what property taxes go to fund. So over time, we're going to see not only this immediate right sizing of the income disparity, but over time, as the state funds those services that generally benefit middle and working class families, and by default, the people who employ them, so the employers and wealthier individuals, it will help them as well. And so over time, you'll see that gap close, and hopefully we can get up from the bottom of the barrel in terms of hosing our middle and low income families in terms of taxes.
Terrific. Thanks for helping break that down for us. And since you mentioned property tax, it's a perfect segue to our next question, which is, over the last several years in Illinois, there's been a significant amount of dialogue regarding the need to address our high property taxes in the state of Illinois. And specifically, how does the Fair Tax Amendment relate to property taxes? And does it further the discussion to someday reallocate how schools are funded, et cetera, moving forward if the fair tax does indeed pass?
Absolutely. And for background too, so when I was at Chicago Public Schools, one of the things I did too was forecast the annual revenues for the district. So I worked for 4 years forecasting and understanding the property tax system, submitting the levies to the county clerks. So I have a great deal of understanding about how property taxes work. That led me to be appointed by the governor as one of his 2 gubernatorial appointees to the Property Tax Relief Task Force. That task force has somewhat stalled out, but nonetheless, my expertise in property taxes is pretty strong. And what I will say is, when you look at your tax bill, on average across the state of Illinois, 53% of all property taxes paid simply going to funding K-12 public education. So the vast majority, I mean, some folks like to, there's mosquito abatement districts and tax collection districts and all these things. But it's important to look at those things and figure out how to optimize and make those more efficient. But the real meat of this issue is in how schools are funded, because over half of your property taxes go to paying for schools. And so what we're talking about here is, and I actually was the lead negotiator on behalf of Chicago for the evidence-based funding formula, the new formula that changed how the state funds its public education system. Now, what's critically important about that bill is, because it holds all school districts harmless, you need new money to be able to change the equation on how education is funded. And it doesn't redistribute dollars. It's only the new dollars that come in that are distributed more equitably. So we need more dollars into that system. And so what the fair tax does is allow us to pump an additional $350 million each year into that system. What that'll do is, over time, now, actually, I should back up again. Illinois is the worst state in terms of funding public education. And that is in terms of, when you look at all the dollars coming into schools, what proportion of dollars come from the federal government, come from the local government, and come from the state. And when you look at Illinois, the last time I checked, the state funded only about 27% of all dollars coming in. That makes us the worst state in the country for funding education. And those dollars have to come from somewhere. People are not going to sit back and just say, well, I'm just going to have a poorly funded school. They care about their kids, they care about their community. They're going to make sure that their schools are well funded and their kids have a proper education. So the only way that they can make that up, the lack of funding from the state, is by increasing property taxes. And as I mentioned before, from 09 to 16, you had education funding declining. That resulted in a precipitous increase in property taxes because they need to make that money up somewhere. So with the state pumping in more money, and it's honestly only doable if we get something like the fair tax in place that produces this additional revenue. You're going to talk about these school districts can back their foot off the gas pedal on increasing these property taxes and hopefully decrease property taxes because the state is now kicking in a greater and greater share. And so what's interesting is when you look at the correlation between state funding and their in property taxes, it's no surprise that when the state funds less, property taxes are higher. So if the state's going to fund more, it needs a fair tax. And when the state funds more, it's going to reduce the burden on property taxes. And as I alluded to on the onset too, that is, that over time will correct itself. And a lot of people are clamoring for immediate relief. And I understand that it's very expensive to do, but we're trying to figure that out. But one of the things the governor did do is include an increase in the property tax credit for income taxes so that individuals' burden of property taxes will be immediately reduced by a modest amount in the immediate term. And then over time, as the proportion of dollars are shifted to the state, they'll be able to reduce their burden, their reliance on property taxes. And over time, it will finally get us out of being one of the worst states in the country in terms of property taxes and funding of education.
That's terrific. I'm sure the superintendents that joined us tonight are more than pleased to hear that as a possible outcome to the fair tax. So moving on, I've heard many opponents argue that the fair tax amendment gives the legislature power to increase taxes on any group of taxpayers with no limits and no accountability, and without any requirement to use the additional revenue to fund essential needs such as healthcare, education, and public safety. If the fair tax passes, has Governor Pritzker or the legislature provided any insight on where and how these new tax dollars will be spent?
Sure. First, I'll address the notion of this changing the ability to increase taxes on folks, and then I'll address the spending priorities. Nothing in the bill changes the ability of the General Assembly to increase income taxes. It only stipulates that you no longer need a flat tax; you can go to a graduated structure. If the General Assembly wanted to, increase taxes on low and middle income class families, it would still go through the same hurdle under a fair tax as it does under the flat tax. Even under a fair tax, you'd still have to vote and pass a bill and sign by the governor a tax increase for middle and low income families. So that burden has not changed. What folks at the highest income scales want you to think is that this is some backdoor way of being able to do that. But the burden has not changed. So the General Assembly still needs to do that in full public discourse. And then you, in electing your representative, if they go and increase the taxes on middle and low income class families, they're not going to have a job anymore. And if they want to put that to the test, I welcome them, because I know the strength of the voting electorate and of working class families, and that's a huge burden under either a flat or fair tax. So I disagree vehemently that this changes in any way the state's ability to change taxes. The requirement is still there that a bill is passed and the governor signed into law, and it's statutorily changed. And none of that changes under a flat or a fair tax. Now, in terms of spending priorities, I'm sorry, Todd, did you want to say something?
No, go right ahead.
Okay. In terms of spending priorities, so the governor actually had a chance to propose a budget prior to the pandemic, but for fiscal year 21, which fiscal year 21 would include half a year worth of fair tax. The reason being tax year is a long calendar year, and the state's fiscal year is June to July. So the fact that you basically get a half a year in fiscal year 21, the governor laid out basically exactly his spending priorities under a fair tax situation. It was only a half a year, but nonetheless, what you saw in that budget was increasing funding for education, increasing funding for critical services, funding the largest ever capital investment. Now, capital dollars generally are tied to specific revenue sources, but the point being, we cannot support a capital program if our operating revenues are insufficient, because that money has to come from somewhere. And so the largest capital bill, in state history, which we passed in the spring of 2019, also will be stifled by not having the operating revenues available to support the ongoing infrastructure of the state, and thereby allowing us to build out our physical infrastructure vis-a-vis capital projects. So those spending priorities are laid out there. It's fairly clear what he and the General Assembly intend to spend that money for. And a lot of it is statutorily required to be transferred to the pension funds too. So we know that that the state is going to meet its obligations for pension funding, and the fair tax helps us do that. So that is another key spending priority for the state to again meet the promises of its workers.
Very good. Thank you for that. We are fast approaching our 7 p.m. deadline, so this will be our last question for the evening. And it deals specifically with tax loopholes. I know you indicated earlier that Illinois is already operating as lean as it ever has, but the question is basic. It is, if tax loopholes are not closed, how is going to tax the rich will move the state forward if we don't close the tax loopholes?
Yeah, if we don't close the tax loopholes, then the income gap is still going to grow, and we're still going to have our revenue for our income tax revenue is still going to be insufficient to grow to meet our expenditure needs. So unless we close these loopholes and create a system that's fair, we will never achieve some level of income inequality, and therefore will continue to burden lower middle income class families by forcing them to, in effect, pay twice amount of their income in taxes as wealthy individuals do. And so the fair tax is crucial to being able to force the wealthiest individuals, again, only 3% of individuals, to pay their fair share. And it's going to allow working middle income class families to receive a small tax reduction, but the biggest thing is avoid a flat tax increase or an increase that would place the burden on them. And so this is kind of a battle between the wealthiest folks who want to keep what they've gotten over the years. And by default, if they get to do that and they defeat the fair tax, it's going to fall down on middle income class families. And it's going to create further inequality and the systemic and persistent issues in the state's finances.
Well, that really concludes our questioning. So before we wrap up, I would just like to ask you, Cameron, if there's anything that we missed, or if you have anything additional to add on the fair tax. You certainly can take as much time as you like if you think that we've actually missed anything, or you could certainly wrap up.
Sure. Yeah, absolutely. Going through my notes here, I'll leave you with one kind of funny anecdote. I have a friend of mine who's far wealthier than I could ever imagine to be, and probably one of the wealthier individuals in the state. And his comment was, under the fair tax, not only will my tax dollars be going to finally solve financial problems in Illinois, but the price of boxing up my precious artwork will be higher than the price I pay in additional state income taxes under the fair tax. I think that just sums up everything so eloquently in this situation that, listen, if you can afford to have fine art on your walls and have everything afforded to you in that sense, we really don't feel that a 3 percentage point increase in state income taxes is an undue burden. And then furthermore, that this will create equity across the broad spectrum. And finally, I would be happy. I've been working in public finance for 10 years now, a little in the state of Michigan, but primarily in the state of Illinois and city of Chicago. Well, finally, I can't wait for the day that we finally can look back and say, we've solved this problem, we've gotten out of this crisis, and we've done it in a way that preserves the dollars and preserves the sense of family and accomplishment of our middle and working class families. So I really hope this has been informative. I'm not a political guy. I'm kind of just a finance guy, and so I don't really have a bent here. I've studied tax policy and economic policy for 15 years, and I do truly feel it's solid tax policy, and it's what is fairest for the people of Illinois, and just would really appreciate folks to consider this strongly and possibly consider casting a vote in favor.
Well, I thank you so much. I think tonight has been tremendously informative, and also want to thank you to your service for the state. We're certainly lucky that we have people like you helping craft sensible policy that hopefully moves the state forward and gets us out of puts all of these big issues behind us and can really move forward and be the great state that we know Illinois is. Certainly it has a tremendous workforce and employer base, and we're all very proud of that. So I cannot thank you enough for sharing your time with us this evening. That does indeed conclude our program. For future programming, please stay tuned to tcdfillinois.org. And as I said earlier, we'll make sure that we get the migration survey article up on the TCDF website if anybody has any interest in taking a closer look at the New Jersey study. But Cameron, I cannot thank you enough. It's been an amazingly fast hour, and hopefully someday we can do this again on a topic not tax related.
I would enjoy that. Thanks for having me, Todd.
Yeah, thank you so much.